Hey folks, welcome back to the channel. It's Liquid here. Sorry I haven't been making videos in a while, but now I'm back from vacation, so I'm going to be posting weekly market updates. And it seems like April has been a crazy month so far, with the most volatility we've seen in a while. Today is Tuesday the 15th. The market is going to open in half an hour, but just from looking at this daily chart of the S&P 500, things are not looking good. First of all, we have this downward trend that started in February, and as long as the market stays within this bear channel, the price will tend to move lower over time. Another bearish signal is we have this death cross at the end of yesterday's market close. And a death cross is when the 50-day crosses below the 200-day moving average. And usually this indicates further price weakness in the upcoming days. So here on the chart, we have the red line, which is the 50-day simple moving average. And then the gray line is the longer 200-day moving average. And as you can see, as long as the red line stays above the gray line, then the market tends to move up. But there were times in the past, like in 2022, where we had a death cross. And even though the market went up following that event, the next several weeks led to a big 18% correction in the market. And the shorter 50-day moving average continued to stay below the 200-day. And finally, we have data going back a century showing what happens to the stock market over the short term whenever you get a huge green candle like this from last Wednesday. This was a 9.5% move. And there were 13 times going back to the 1920s where we had a one-day move that was greater than 9%. And out of those times, the market was up only 23% of the time the following day, which means it was down 77% of the time, or more than 3 out of 4 times. And that is what happened this time as well. Now, today is Tuesday, so by the end of today, it would be the 4th day. And according to this data from Quantifiable Edge's X account, it's this column over here, and you can see the wide range of movement at the 4-day mark when this has happened in the past, all these different years. Most notably, these were during market correction years like 87, 08, 2020, when you do tend to see these huge volatile swings in the market. And overall, the market was actually down 2.6% from the close of Wednesday, which was at about 54.57, and the median return was lower at minus 4.58%. The main thing is that there was only a 38% chance the market was higher. So about a 62% chance the market is going to close today below this purple line. And so far, the 1, 2, 3-day changes, in terms of the general direction, have all been correct. Even though the second and third day win rate is almost like a coin toss, 46%, so that's pretty close to 50%. But nevertheless, the averages are still down, and that's what we've seen over the last few days. One day ended here, the second day ended here, the third day ended here, also below, and we'll have to see what happens today. But if this chart holds up, then there's a 62% chance we're still going to end today lower than last Wednesday. And even 10 days after the big run up, you can see the returns on average still doesn't look very good. So in terms of the next week or so, I am leaning towards bearish. It's more likely for stocks to go down than up. Right now, we are still in this bear channel that is heading down. And there's a few different ways this can play out. Most of it is towards the downside. As you can see, it's touched the top of this channel 1, 2, 3 times. So as the market comes up this week, it will likely touch the top of this channel again. And if it gets rejected from there a 4th time, then that's obviously very bearish. If it goes above the channel, then that's not bullish yet, because the market likes to overcompensate in both directions. Last week, it extended below the channel. So if it comes back up, then the momentum could carry it above the channel, which will parallel the previous movement in the opposite direction. And that would just be a normal reaction for the market. It's not necessarily bullish unless it bounces off the top of the bear channel and continues heading higher. And if that were to happen, I would also expect the 50-day moving average to cross back up above the 200-day, and that's when we'll get back into bullish territory. But that is still a long way off, and I think there's less than a 50% chance that will happen, as most likely we're going to continue heading downwards as per the reasons I've mentioned in this video. So once again, as long as the price action is contained in this channel, we have to expect prices to go lower. If it breaks out of the channel, then that's more of a neutral sentiment, and it's still a long way before it makes sense to go bullish, because the price basically needs to go above, let's say, about 5,800, as that is also where you can see the previous support was broken and then it acted as resistance. So that is the level that the bulls have to push the price through in order for the momentum to change direction. And at this point, it doesn't really make sense for the price to move up there without having some kind of down leg first. So that's why short term, I'm leaning bearish, but over the next 1 or 2 months, medium term, that's harder to say. It's going to depend on earnings and news about deregulation or tax cuts, maybe tariff reduction. A lot of new policies that they can announce can really move the stock market in one way or the other. But the only thing I am quite certain of is that we are very likely going to see more volatility in the next couple of weeks, because that tends to be what happens when the VIX is high. Currently, the volatility index is sitting at 30. As long as it's above 25, you have to expect more big swings in the market on a daily basis. So this is a really risky time if you are trading in the markets. You've got to watch out for gap fills and reversals. For example, there's a gap right here in the S&P 500. So if the price were to go back up into this gap, it'll likely get filled, but it could also easily turn into a false breakout setup where it then just dumps. So you have to be vigilant and make sure you don't hold on to any losing trades that could greatly extend your losses. I think a more reasonable strategy right now might be to look at bonds rather than stocks, especially short-term to medium-term bonds, not a lot of risk in them, and wait for the market to settle down a bit before jumping back into stocks. So that's just an idea. Anyway, thanks a lot for watching. Good luck with your finances, and I'll talk to you in the next one.